Good morning. Happy Father's Day to the world and all the traders internationally and US and MMTs and everyone alike. For all the fathers out there, it's time for you to zero in on what's really happening as far as I'm concerned. What we have here, it's called a VXN. Basically, it's a Nasdaq 100 volatility index. And when this volatility rises, the fear rises. So when we go up like we did in 2008 to the moon up here at 80, that's when we started to put a bottom in the markets. Okay? And the fear was at extreme levels. And bull and bear sentiment were also at extreme levels during this period of time. In 2009, when we did put in the bottom, you can see that when this went straight down, the stock market was rallying up to all-time highs. Then we got into year 2010 here, and we shot straight right back up to 50. And if you go look at the Dow charts that were done yesterday with Goldman Sachs compared to Goldman Sachs, is that you can see that when this fear spikes and it stops going, that's when you put in short-term bottoms. And the higher that the fear level goes would also be short-term oversold markets. Let's let that be known. The other important thing is that when we take a look at the 2011 versus 2010, I'm going to pull this part of the chart up. But look at this monthly level right now. Now remember, it's the month of June. But you can see that we have not clearly broke the highs yet. The high reading here was 26.23 so far. When you're down here at levels like 15, 13, that means that two things. One, all the bulls are in, and there is very little fear, and everything is hunky-dory. And just everything is wonderful. Well, when we were at the bottom here, and this is related to Nasdaq Comp and Nasdaq 100 now. See where it says Nasdaq 100 Volatility Index. When this was spiking, we were selling off in names. People were, getting out of the market. Fear. Fear was increasing. You're above the 10-month moving average. You're slightly at the 20-month moving average, and the 100-month moving average had served as a little bit of resistance. The key in how to use this is when it peaks and it stops, you start buying equities at the bottom that are oversold for short-term bull rallies. On the other hand, shorting a market is when everyone was in at the top, right here. There was no fear whatsoever in the month of May, and they had to pay a price for that. And you can see here that when we called the market bottom or the market top, this was at the low of 16.30. And yes, it lags moves, it lags all indicators, all public analysis, all standard technical analysis lag the actual event that's going to happen. And it doesn't, what good's it going to do you? Because by the time you start getting short, where most people didn't even get short this market. We were short this market back here on 5-1. And if you go to stockmarketfunding.com homepage and type in Nasdaq 100 or Nasdaq Comp, you will see there that at the end of April, the last week of April, there was going to be a good correction around the corner. That is the truth that you want. You want to go to other day trading websites and get a bunch of fluff? Hey, please sign off of this now. You don't belong here. This is reality. This is truth. This is before the fact. This is not after the fact. If you're tired of buying services that start talking about all of this after the move, you didn't make any money. What good's it do you? Doesn't do you any good. Let's learn to apply proactively using what it takes to understand when market tops and market bottoms get put in. If this continues to move higher, we could go up here. Here is the high for 2011 right here. 32.46. We're not there yet. We haven't put in a double top high yet, and this is a monthly reading. Now, having said that, let me go to the weekly reading, which is here. And you can see clearly where these very low pessimist, I mean, the pessimistic level is up here toward 50 in 2010. That was the 2010 high. And that was back in the summer when we were doing all of our analysis then, that we would put in, a bottom and we would go higher. Look, on this one here, right here, you have a 3-week ascending breakout above the 10-week, the 20-week, the 40-week, the 50-week. It got up above it, and it got up to the level right here of 25. There is possibly more room. You can pull back and consolidate and break higher. We will be measuring the 3-week breakout, but see, we've been correcting for 7 weeks, but you're only seeing, what you've seen here was a consolidation weekly. It broke up, kind of faded back, then it broke higher, and it broke these highs here. When everyone thought the market had the bottoms put in every time they were buying. Yeah, we broke out, then it faded back, but then we've made the higher high here. And we're going to approach what we call the last reversal over here was in the month of 3/13 of 2011. We had peaked and we were short that period of time. Go find your references on stockmarketfunding.com homepage and go do your work correctly so that you can learn when to be selling into markets or when to be buying markets. And I bet most of you are wrong. And you have to live with the consequences. And yes, it does take education. Until the day you get the right education, you're just going to be part of this chart. The thing about it is, MMTs, we will see that when we break out, if we pull back and we remain above these key weekly moving averages, that means that we're just in a simple oversold, short-term oversold market that's ripe for a bounce. However, because of this reading here, any upside move in the short term from an oversold market that we're short-term in is we will be selling into any rallies at the top. We will be shorting equities higher once they make their move off the bottoms, because there's nothing here that suggests to me that we have peaked to where a market bottom would be put in. What we look for, MMTs, is a huge spike up and it stops, and that's when a market would capitulate. Fear would capitulate like this here. Here's a good example of fear capitulation right here. This is what we look for. We look for that run to keep running. Now, that was extreme fear when markets got back in 2009, 2008. They did put it. They came down, then they popped up, but here's where that long-term decline was. And in 2009, we didn't put a bottom in. We rallied all the way up. In 2010, there was a hiccup there. And that's when the fear shot up to that kind of level. But let us not forget that we had a capitulation that got the fear indicator that high back in May of 2010. Yeah, we did. That's the reality. This particular high here on a weekly is going to be tested, and or we pull back and set up, because we do not have a true bottom in the market. There's a difference between a true bottom and how a bottom is really put in, then short-term overbought, short-term but oversold now is where we're at. And so when you get short-term oversold, these things pull back and they set up. We'll be monitoring the VXN fear indicator very carefully, how to apply that to long and short trades, how to apply that using calls and puts.